Happy Friday, it's Chris. What is going on over at the Federal Reserve? It's like mutiny, as one economist described it, and crazy. Like a lot of Fed members are starting to flip-flop and go against what Fed Chair Powell has been talking. The hawkish tone that he's had for quite some time now is now really getting some pushback, and it looks like 5 Fed members have already flipped and really shooting for more dovish tone, which is more in favor of low interest rates. And it looks like we're going to have a new Fed chair, maybe a potential shadow chair soon. The market's probability is that it's going to be Governor Waller. So hopefully Fed Governor Waller gets it, because he actually would be a very good Fed chair. I would think that would be a great choice. But I really want to talk about what all this chaos means for interest rates, and can't do that without at least showing you a couple nerdy graphs. So here we go. Nerdy graph number 1, you're looking at 30-year fixed interest rates, this red line, and you're looking at the Fed funds rates, what the Fed raises and lowers when they cut rates. And so you can see, hey, they work kind of closely together, but certainly they do not walk in lockstep. So certainly the Fed Reserve can cut rates and mortgages don't go down. And we saw that just about a year ago, right? Whew. Another nerdy chart. Looking back a year, this is September of last year when the Federal Reserve started to cut interest rates. And you can see by this orange line, which again is our 30-year fixed line, interest rates from about 6.1, and they skyrocketed all the way up to over 7% while the Federal Reserve was cutting rates. So a Federal Reserve that cuts rates is certainly no guarantee that mortgage rates are going to go down. But I do think it will be different this time. Now, granted, a lot of economists believed that interest rates would not have been this high for this long. And I was one of those people. So I was clearly wrong. But we are actually in a lot healthier spot as far as the 10-year Treasury, which is really what drives mortgage rates. So the Federal Reserve, they influence the Treasury and they influence mortgage rates. And I would say roughly 70% of what drives mortgage rates is what the Federal Reserve does. And that's a lot, right? But clearly, as we can see from last year, that doesn't change everything. It is no guarantee. But right now, let's talk about Fed rate cuts. So right now, we're looking at our September probability of rate cut is now up to 88%. Now, mortgage rates have already gone down 0.25%. So while the market is pricing in a 0.25% rate cut in September, just know mortgages have already gone down 0.25% in anticipation of that. The market moves in real time. So probability, 88% rate cut September 17th. October 29th, another 0.25%, not with quite as high a probability, but a 58% probability. So couple rate cuts look like they are on the table based upon market probabilities. So this is a really good thing. Now, the biggest reason why mortgage rates have improved over the last week, 2 weeks, is because the 10-year Treasury, like I already mentioned, is going down, but so are mortgage spreads. This is actually a bigger part of the story. So we're looking at yet one more nerdy chart, and here we have a 10-year Treasury. Most recently has gone from 4.4 down to about 4.2 here today. But we see our mortgage rates here, this orange line, going from 7 down to 6.57 today. So this gap between the 10-year Treasury and the 30-year fixed is widening. That is really, really good news, because if that means that the 10-year Treasury doesn't have to go down a lot for interest rates to continue to improve significantly. And so even if the 10-year Treasury went down to close to 4.0, even 3.8, it's not that far away. We realistically could have 6% mortgage rates soon. So a lot of nerdy charts going on here. Hopefully you guys appreciated looking at it. If you guys do have any questions, let me know. Fingers crossed for some lower mortgage rates going forward. Happy Friday.